Let's be honest for a moment. What do we, as income investors, really want? We want a rock-solid investment that delivers a steady stream of passive cash flow. Not just stable, but ideally growing year after year. All we want is to sit back, relax, and watch the cash flow roll in and steadily grow, without stress and without worry. And yes, that's absolutely possible with the right dividend ETF. Today, we're talking about one of my personal favorites, the SPDR S&P US Dividend Aristocrats ETF. I'm personally invested, and right now I'm already collecting a few €100 every quarter. My long-term goal? To push that up to €1,000 or more per quarter from this ETF alone. Quick disclaimer: this is not financial advice. Everything I share here is based on my personal opinions and experiences. All right, let's dive in. SPDR S&P US Dividend Aristocrats ETF. As the name suggests, it focuses on dividend aristocrats. But what exactly does that mean? Dividend aristocrats are companies that have increased their dividend payouts for at least 25 consecutive years. These are some of the most reliable, resilient businesses out there. Companies that kept raising dividends even through recessions and crises. Think of giants like Coca-Cola, Johnson & Johnson, and Procter & Gamble. All three have been raising dividends for over 60 years. Incredible, right? Now, for the European version of this ETF, the definition is slightly relaxed. Here, companies need only 20 years of consecutive dividend growth. Still, that's an impressive track record. So what do we get? A portfolio packed with solid U.S. dividend payers you can rely on, both for cash flow and growth. And isn't that exactly what every income investor is looking for? Here are the top 10 holdings of the ETF. As you can see, the ETF is built on solid value stocks. While based in the U.S., most of these companies operate globally. And here's the sector breakdown. Notice something? Tech exposure is quite small, and financials are also underweighted. Instead, industrials, consumer staples, and utilities dominate. Personally, I like that. It adds diversification to my portfolio, since, like many investors, I already have plenty of tech and financials through other dividend ETFs, like the Fidelity Global Quality Income ETF. So, how good is this ETF really? Since its inception, it has delivered an average annual total return of about 12%. For a dividend ETF, that's outstanding. When we compare the total return performance with the MSCI World, we see that the SPDR ETF has managed to keep up quite well, something very few dividend ETFs achieve. Yes, I know we're dealing with a US ETF here, so the more appropriate benchmark would actually be the S&P 500. And compared to the S&P 500, the picture looks very different, of course. Still, up until around 2020, the SPDR ETF managed to hold its ground. Now let's take a look at the SPDR ETF's performance chart. In green, you see the total return. In blue, just the price performance. You'll notice that most of the total return has been driven by price growth, although in the last 3 years the price has stagnated. That's likely due to rising interest rates since 2022. When rates go up, many investors shift into safer assets, and stocks lose some demand. But interest rates move in cycles, up and down. So I'm confident the ETF's price will recover over time. If you found my insights useful so far, a quick like and subscribe helps the channel reach more investors like you. Thanks. Let's take a closer look at the dividends themselves. From the start, the ETF's dividend yield has remained a little over 2% per year. In my view, That's the ETF's main drawback. I'd really like to see a yield closer to 3 or 4%. But here's the trade-off. While the yield itself stays modest, the real strength lies in dividend growth. The payouts have been growing by roughly 7% each year, something I really appreciate. In other words, it's not a high-yield ETF, but rather a dividend growth ETF. So why doesn't the yield rise along with the payouts? Because the ETF's price has been climbing too. And since yield is calculated relative to price, the percentage stays about the same. Here's the chart of all past distributions. And this is one of the things I love about this ETF. Payouts have been stable, reliable, and almost always increasing. Only in 2024 did they slightly break the pattern. At that pace, dividends double roughly every 10 years, which also means your personal yield on cost doubles. Another thing I love, the payouts are evenly spread across the year. Every quarter, you get about 1/4 of the annual dividend. Unlike many European or global ETFs, where dividends are heavily concentrated in summer, this one spreads them evenly. My plan is to buy more of this ETF during the next major market correction, securing a higher yield and boosting my long-term cash flow. Now, let's talk about popularity and competition. With nearly 3 billion euros in assets under management, this ETF is huge. But since 2023, its fund size has been shrinking slightly. Why the decline? Rising interest rates made value stocks less attractive, pushing investors toward other assets, such as bonds. Or maybe investors shifted into other dividend ETFs. One strong competitor comes to mind: the Fidelity U.S. Quality Income ETF. Unlike the SPDR ETF, Fidelity's fund has been growing rapidly in size. Let's compare the two. Since its 2017 launch, Fidelity has massively outperformed SPDR in total return. Dividend yield is similar, just above 2% for both. Dividend growth is about 7% per year at SPDR and around 11% at Fidelity. That's a notable gap. The real difference shows up in the allocation. Fidelity is loaded with tech, which explains the strong ETF share price growth. About 35% of the fund is tech stocks like Nvidia and Microsoft. Another 10% is communication, which is basically more tech. So Fidelity is a tech-heavy dividend ETF. Same yield as SPDR, but much stronger price and dividend growth. It's a fantastic ETF, no doubt, but it also trades at a much higher price-to-earnings ratio, a result of the sky-high valuations in tech. Still, many tech companies are maturing and adopting solid dividend policies. Some will likely become dividend aristocrats in the future, and when they do, they'll show up in the SPDR ETF as well. Did you know that Microsoft is already in the SPDR ETF? It's been paying dividends for over 20 years, though with a relatively low yield, which keeps its weight in the fund small. So why do I personally hold the SPDR ETF instead of Fidelity? 2 reasons. I love the aristocrats concept, companies you can truly rely on. And my portfolio already has plenty of tech exposure. But what if there were only these 2 ETFs out there? Which one would I take? The answer is simple: both. All right, that's it for today. I'd love to hear your thoughts on this ETF or U.S. dividend ETFs in general. If you enjoyed this breakdown, don't forget to hit like and subscribe. It helps the channel reach more investors like you. Thanks for watching, and I'll see you in the next one.